What is your strategy as a new investor or existing investor when market is down? That's a question I'm trying to answer. I know your portfolio is also probably down, my portfolio is also down, but what is that strategy makes you peaceful? That is something very important. And I'm doing an evening walk, so I'll have some conversation with you. Now, to me, when these times when it comes in red, I feel a little bit excited. Obviously, some part of it, nobody wants to see the portfolio seeing down. Everyone want to see a green portfolio at the end of the day and feel happy about it. But then you have to come to the terms. The market doesn't move in one direction, and definitely not in a way you think, because there's so many other factors which are involved in short term, long term, medium term, and probably it is out of my comprehension, and I have to accept that it's too hard basket for me. But I have to follow a process. As useful weekend investing is all about finding your peaceful points. What is the process? And that's what I want to discuss with you. If you're a new investor, not started, there's an opportunity for you. If you're an existing investor and you probably seeing your positions down, what could you have done, what you have done better, and how I manage that whole thing forward. That way things becomes very peaceful for me. Start with one thing. If you are a new investor, you should be happy about it because you get an opportunity to get in. Now, which stocks to buy, which stocks not to buy is a question of a complete different topic altogether. If you want to know how to go about, type in a comment box below. I will try and create a new video on that, or probably will jump in live so we can discuss some few strategies around that, because that's an opportunity. And I think the best way to start with is an ETF, which is the best approach if somebody is new, starting off with it. Not a sectors-based ETF, just simple broad-based ETF to get started with that. But you have to have some kind of smarts in that process. Otherwise, it's not a market for buy at any price. You have to have some smarts in that process, and I cover that in detail in 3 hours specifically only on ETF strategy, how you pick it up. Now, second part is about when you have a portfolio and it is down, and how you should read it. First of all, there's a one simple approach I go about is dividing the entire portfolio into two parts. One is the part which is a long-term portfolio, and one is it's a kind of we call it a peaceful weekend investing lab portfolio. Is always to look for long-term, not necessarily trading, because that's not our objective. Obviously, it depends on lifestyle, because you have a lifestyle, you tend to work towards that, and you want to know how you go about. So make sure your portfolio is divided and you take the positions based on that. That is more important. I want to cover more in deep later, but I just want to touch this particular point, that you can have a lifestyle based approach where if you have time during the day, what you should do, when you time during the weekend, then what you should do, and time during the month, and what you should do, and accordingly you work towards your positions. Otherwise, it's going to be very challenging, especially in these times. Now, this part of the section of the video, I want to cover some few of the strategies. Obviously, there's nothing called right and wrong. It's just my approach, and it could be wrong from your perspective, how you're reading it. It depends on how you're absorbing and digesting whatever I'm saying. It is working for me, so I'm just sharing that. So no recommendations how you should follow that. I'm just sharing my experience. Now, one of the things which has happened, which has worked for me, is specifically, like, I'll give you an example of a stock which I've identified for long-term positions. Obviously, it cannot be more than 10-15. If it's there, then it becomes very hard to manage, because you have to study a lot about fundamentals of the company and so on and so forth. You need to have a strategy to buy it, and you need to value that, and you need to buy that particular stock at different times, obviously, to build your position over a period of time. I'll give you one example. I shared that on my Twitter. If you're not following me, you can follow me at @Shivendra. Is that in 2020, I think around that time, I decided to give some shares on Google for my son's birthday, right? I thought it was good value and I wanted to buy it for long term. Fast forward 26, I had 3 tranches of it. At every 2 years, I added on to it. Now I looked at each of the tranche. One tranche was 4.5 or 4.8 times to the original price. The another one was around 2x, and third one was 1.5x. Now, the lesson which I'm trying to say is not to boast about it. I didn't do any kind of magic there. It just followed the same process of finding the intrinsic value of the company and trying to buy it at the right time and adding to it. Now, Obviously, the stock has given dividend over a period of time, which is an ice cream money. But now, if the stock cracks a bit at this point, has gone up, you're not like jumping because you are sitting on a decent profit. Obviously, you can take some money off the table to reduce your thing and feel about so that you cover your bases. But that's not an objective, right? So do that as well, because if stock has run up too much beyond my intrinsic value, I might take some position off the table as well. It's for the long term positions, right? So nothing to worry about it. Now comes a lap position, which is where the more trickier most of my time goes. For example, I know this particular stock and it's purely price action based. It is initially I don't study fundamentals of the company. I try to do price action based and then start studying and see whether this is a long term or it's a tactical play, because sometimes you have to do a basket approach based on like a chemical play, whether fertilizer play, whether it's an mineral play, and so on and so forth. So you can do that. You're very clear about those sectors. Understanding different sectors is super important, and then which one becomes a long term, which one not. And then there could be individual companies which is having some kind of tailwind, and you have to understand and study what kind of tailwinds that company has. Now, in that particular thing, there are multiple strategies one work out. One is you buy, and if stock goes in your direction, you hold and basically take some money off the table depending on your risk strategy, purely risk strategy, because sometimes these companies are small caps, they're not definitely large cap, and you are trying to play a very tactical play, but with the intention to have a long-term view of some of the stocks might be having some big tailwinds. Other approach is that if let's say stock you bought had gone 40-50% straight away, it's advisable to take some money off the table, because then it becomes very peaceful, because you have already now have some profits booked on it. If from there's a bit of a drawdown, you can at least manage that volatility. It's all about managing the volatility, managing your risk, and others is pure having a risk mitigation plan, so that you don't want to hold on to and become a loser positions where stocks have gone up 20, 30, 40, 50%. So that is one approach to it. And third approach is, sometimes I know that there is a particular stock which made 100% of it. I will take my capital off and let it sit there and see how it happens, and manage that with some monthly chart. So that's the way I can manage multiple positions. Again, I'm not like God, I'm also learning. I'm trying to manage different tactics approach to build my positions for long term. The best and peaceful point is that if I bought a stock in lap portfolio and it's gone up, I definitely will take the money off the table and start bringing my average down, right? Because that way it becomes very peaceful for me, because now there's nothing for me to lose from there. At the max, it will break even. And if I'm not 100% convinced of the story and the stock has gone up 100%, I'll still take my capital off and let it sit the rest of it and keep playing price actions whenever the opportunity comes, right? One such example I want to give you, these are all just names which I'm throwing up for no recommendation, is like Moltech Packaging. It went through a bit of had a tailwind, then obviously because of pharma, they're trying to make packages. Stock corrected a bit. I've taken the money off the table. I've got a big chunk of portfolio which is all there, so I don't have to look at them on daily basis. Yes, my capital would be opportunity costed there. People might say that's okay. I'm okay with that at this point, because every decision you make, there's an energy to it, right? I wanted to wrap up in this short video. What does it mean to it? One, if you're new, you should be happy. Start with ETF, look at it and have some strategy there. If you have existing portfolio, you need to segregate them in a proper way with long-term portfolio and lap portfolio, which we call it, and try and see how you want to manage that based on your lifestyle. And this is some of the approaches and strategies I've taken, work for me. Just I want to know from you, what was your key takeaway and what did you learn from it today? Is there any value, or you think I should correct my strategy? I'm more than happy to listen from you as well. That way at least I can benefit from your learning as well. Till the next video, I'd like to say peaceful weekend investing. My name is Shivendra. I'm trying to help and decode and make investing easier, simpler, and so you can earn first dollar peacefully as the busy professionals we are in. Thank you. Bye-bye.